Uncover true value. Analyze deeper.
That's key. So we'll be exploring the company's core business, how it's performed since that IPO back in March 2025,
Right.
what the market seems to think about it, and, potential paths ahead, both good and maybe not so good, according to these sources.
Okay, let's just jump straight into the company's story then.
Yeah.
Where did CoreWeave even come from? These sources trace it back to 2017.
Uh-huh.
Starting life as Atlantic Crypto Corporation, focused on crypto mining.
Right, crypto mining first.
But then, just a few years later, 2019, they made a big pivot, rebranded to CoreWeave, shifted entirely to AI infrastructure. They're based in Livingston, New Jersey.
And that pivot is so critical, isn't it? The sources really highlight it as setting the stage for their core competitive advantages.
Like what specifically?
Well, they talk about CoreWeave having specialized AI infrastructure. So GPU and CPU compute services specifically optimized for intense AI training and inference workloads.
So not just generic cloud stuff.
Exactly, not just general cloud.
Right.
And they've built their own layer on top of that, a proprietary cloud platform designed for automation and efficiency, which the sources suggest is, key to handling these demanding AI tasks at scale.
Right.
Plus, repeatedly mentioned is the strength of their strategic partnerships, especially with Nvidia.
Yeah, that Nvidia connection seems to pop up everywhere in this material.
It seems absolutely foundational. It gives them that crucial access to the latest, most powerful GPUs, enabling them to offer what's often seen as competitive pricing for this high-performance compute. And it gave them a significant, early mover advantage in this very specific high-demand AI niche.
So beyond just providing the raw compute power, what else are they offering? The sources detail their offerings. Things like bare metal access to NVIDIA's top-tier GPUs, the H100s, A100s, V100s.
Right, the powerful stuff.
They also provide multi-tenant Kubernetes and that mission control platform for optimizing GPU use.
Okay.
They even offer AI professional services like consulting, managed services.
And a major strategic move highlighted really recently is that $1.7 billion acquisition of Weights and Biases. That was February 2025.
Right, WMB. How do the sources see that fitting in?
Well, the interpretation seems to be that CoreWeave is aiming to create an end-to-end workflow for AI developers, moving beyond just compute to offer tools for managing the whole machine learning lifecycle.
That makes a lot of sense, building out the ecosystem.
Exactly.
And their end markets, according to the sources, aren't just one type of customer.
No, it seems pretty broad.
They serve large AI startups, OpenAI, Mistral are mentioned, bigger enterprises across sectors like finance, healthcare, media, and also research, academia, government, defense for that high-performance computing.
And to meet all that demand, the recent strategic initiatives the sources detail are, well, they're massive.
Yeah.
Beyond the Weights and Biases deal, we see these enormous data center buildouts. There's mention of a $1.2 billion lease for a facility in Kenilworth, New Jersey, signed back in August 2024.
Wow, $1.2 billion just for a lease.
Yeah, and they've established a London HQ UK data centers in 2024. Plus, there's a planned $800 million build in Frankfurt for 2026.
And Singapore too, right?
Singapore campus also planned for 2026. It's a global push.
That's a huge, rapidly expanding footprint. And to finance all this, the sources show they've been expanding credit facilities. There was a $1.5 billion one in May 2025.
Raising capital.
And that partnership with OpenAI, formalized back in March 2024, is highlighted as absolutely critical, leading directly to significant backlog visibility, the sources say.
Right, and the scale of their ambition is really underlined by their stated capital expenditure plans. Sources note CapEx is expected to be somewhere between, get this, $20 billion and $23 billion in 2025 alone.
20 to 23 billion for CapEx.
That's the number in the sources. It's a colossal figure for a company of this relative size.
So geographically, as of late May 2025, the sources indicate they have 32 data centers, mostly U.S.-based.
Primarily U.S., yeah, East, West Coast, Central. But that expansion into Europe, UK, planned Germany, and Asia-Pacific with Singapore planned is well underway or on the cards.
And the sources touch on the sort of pros and cons of each region.
They do. The U.S. offers proximity to Nvidia, but you have high CapEx costs, permitting hurdles. Europe meets data residency needs but faces competition, potential electricity cost issues. Asia-Pacific is a newer market, potential geopolitical risks like, GPU export restrictions maybe. It seems like a strategic but definitely complex global build-out.
Okay, speaking of costs and scale, let's look at the financials. The sources provide key Q1 2025 results. Revenue was $981.6 million.
Right.
And this number really jumps out. That's a 420% increase year over year.
420%. Incredible growth.
Adjusted EBITDA was also strong at $606 million,
Yep.
showing, solid operational performance before certain expenses.
But, and there's a but, what's equally striking, as the sources point out, is the GAAP net loss.
Right, the bottom line.
$149.6 million loss, or a negative of $1.149 per share. And they specifically highlight that high interest expenses were a major contributor to that loss.
How high?
Eating up 27% of Q1 revenue. That's significant.
Okay, so massive revenue growth, good operational efficiency shown in EBITDA, but still a net loss. How do the sources explain that apparent contradiction? It seems tied to that giant backlog you mentioned earlier.
Precisely. The sources emphasize this huge revenue backlog as really underpinning their strategy and, frankly, the market's interest. The numbers cited are substantial.
How substantial?
Ranging between $25.9 billion and $29.9 billion, reported around Q1.
Wow, almost $30 billion potentially locked in.
That's the figure from the sources. And they explicitly call out the $11.2 billion piece coming from the OpenAI deal as a huge anchor for that.
Okay.
Crucially, about 90% of this backlog is noted as being tied to multi-year contracts. That provides pretty significant visibility into future revenue streams.
Right. So the narrative here, pieced together from the sources, is that the company is intentionally sacrificing near-term GAAP profitability and taking on significant debt to fund this explosive investment phase, that massive $1.9 billion in CapEx just in Q1 2025 alone.
Yeah.
All to meet the demand reflected in that backlog and capture future growth.
That's the core picture painted by the sources, yes.
Yeah.
Aggressive investment, funded by debt, chasing enormous demand potential. It's a high-stakes strategy, no doubt.
Okay, let's switch gears then to the stock's performance since the IPO. What do the sources tell us about its price history?
Well, the first thing they point out is the obvious limitation. This was a very recent IPO, March 28, 2025.
Right.
So traditional long-term price history, 1, 3, or 5 years, it just doesn't exist yet.
Okay, so the analysis is focused purely on these past couple of months since late March. What happened right after the IPO?
The IPO price was set at $40. It actually opened slightly below that, $39.
Oh, okay.
But it quickly rallied, closing at $42.50 on the first day. And by April 1st, it was already up significantly to $52.57. That's a, 42% increase from the IPO price in just a few days?
That's a fast start.
Yeah.
But I imagine it wasn't just a smooth ride straight up the whole time.
Definitely not. The sources note quite a bit of volatility. It actually hit an all-time low of $33.52 sometime in April before beginning that strong rally.
Okay.
Key inflection points are highlighted. April 8th, the news about the massive $11.2 billion backlog, including that OpenAI component.
Yeah.
That caused a significant price gap up. The sources say from around $58 to $68.
Wow, that's a big move just on news. And that Nvidia connection we talked about, it wasn't just strategic, it actually impacted the stock price directly.
Exactly. On April 15th, Nvidia's Q1 filing came out, showing their stake in CoreWeave. And the stock surged, according to these reports, from around $65 to $80 on heavy volume. It continued climbing after that, reaching an all-time high of $115 by May 5th.
Okay, $115. But then there was a pretty sharp drop reported around then, too.
Yes, the sources detail a pullback from May 6th to 9th. Dropped around 22% down to $90.
What triggered that?
Well, it happened shortly after they announced a $1.6 billion debt facility specifically to fund CapEx. Some sources interpreted that as maybe triggering some profit-taking after that incredibly rapid run-up.
Makes sense. But it seemed to recover pretty quickly after that dip.
It did. From May 12th to 23rd, there was a rally back up to $109.15. And the period from May 21st to 28th was particularly strong. Showed a significant weekly gain, somewhere around 38-39% reported, reaching $125.02.
And what fueled that surge?
This surge was apparently further fueled by reports that Nvidia had increased its stake, plus news of another debt offering, this time for $2 billion.
So more capital raising, more rallying. It seems counterintuitive sometimes.
That's what the price action in the sources suggests for that period, yeah. It hit a peak of $130.76 by late May.
Okay.
However, it then experienced a notable drop, 9.13% on May 29th, 2025.
And the price cited by the sources as of May 30th, 2025 was where?
$111.31.
Which, doing quick math, That translates to a massive total return of 178.3% since the March 28th IPO price of $40.
Yeah.
Purely based on price appreciation, obviously no dividends here.
Incredible run in just 2 months.
The sources really emphasize the stock's volatility since the IPO, though, noting elevated average true range, or ATR.
Right, how much it moves daily.
Yeah, which for you listening just means how much the price typically moves in a day. And significant daily swings. Volume spikes consistently tied to news events. They even describe the phases since the IPO quite dramatically. The inception ramp, then a parabolic trajectory, followed by a profit-taking correction, and finally a recovery rally. It's been quite a ride for investors.
Yeah, absolutely. And with such a short history, traditional technical analysis has its limits, as the sources correctly point out. Indicators based on longer time frames, like the 200-day moving average.
Well, forget about it.
Yeah, they aren't really meaningful yet. They haven't even fully formed.
Right, you can't really test long-term support and resistance levels when you've only been trading for, 2 months?
Right.
But they still look at shorter-term signals. What do they say?
Yes, they do look at shorter term. For moving averages, the general consensus across the sources is that the stock has been trading well above its short and medium-term averages, like the 20-day and 50-day simple moving averages, SMAs.
And that means?
Well, it's consistently interpreted as a sign of strong bullish momentum. The trend is clearly up.
I found it interesting, though, that the sources reported different values for the 50-day moving average in late May. I saw numbers ranging from $59 all the way up to $110.
Yeah.
It really highlights just how formative and sensitive these early indicators are, doesn't it?
Absolutely. It likely depends on the exact start date they use for the average calculation, or maybe the data provider. But the key takeaway across all the sources, regardless of the exact number, is that the price is significantly above that 50 DMA.
Okay.
And that 50 DMA itself is trending upward sharply, and it's seen as potential dynamic support if the price were to pull back. Some sources even mention early signs resembling golden crosses, short-term averages crossing above slightly longer ones.
Okay. What about momentum indicators like RSI,
Right.
Relative Strength Index?
Ah, the RSI. That's
Yeah.
frequently highlighted in the sources, particularly the 14-day RSI, as being in overbought territory for much of May.
Overbought meaning above 70.
Above 70, yes. Often pushing into the 80s or even higher, according to some reports, 83, 85, maybe even near 90 at the peak.
So the interpretation there is the price moved too far too fast, according to that signal.
That's the classic interpretation offered by the sources, yes. They see the high RSI as a kind of warning sign that the stock might be technically overextended and potentially due for a period of consolidation or maybe a pullback just to cool off a bit.
Right.
By May 30th, some sources noted it was still sort of nearing overbought, maybe around 65.
A strong trend, but flashing maybe a yellow light on the dashboard.
Yeah.
How about MACD?
The MACD, moving average convergence divergence, generally indicated bullish momentum through May as well. Bullish crossovers were occurring.
Okay.
Though some sources did hint that maybe the momentum might be subtly weakening towards the end of May, despite the MACD value itself remaining positive, just less strong, perhaps.
And the volatility we talked about earlier, that's just a constant feature.
Yes, the sources repeatedly point to the elevated ATR and those large daily swings, including that 122% jump as clear evidence of the stock's high volatility profile since day one.
Okay. Based on all that recent, albeit short, price action, what support and resistance levels do the sources identify?
Well, key support levels mentioned start way down at the IPO price of $40 and that April low around $33.50.
Right, the floor so far.
More recent price action puts potential support around the $90, $100 area. $100 is obviously a big psychological level, and it was tested. Prior consolidation in the $80, $90 range is also mentioned, along with various other lower levels cited here and there. $90.24, $88.74, $80 and 30 cents, 73 cents, 73 cents, $61, 52 cents, $57.31.
Sure.
And as we just discussed, that rising 50-day moving average is seen as potential dynamic support.
Got it. And the hurdles on the way up. Resistance.
Resistance levels like $84, $107.39, and various points in the 120s and near $130 are also listed as potential resistance zones. But really, the sources view the entire move since the IPO as one massive breakout from those initial levels.
Right. Okay, shifting gears now. What does the material say about who's been buying and selling? Institutional activity, insider actions.
So post-IPO institutional activity, according to the sources, is primarily gleaned from those Q1 2025 13F filings.
Right, the reports, big investors file showing their holdings.
Exactly. Those were reported around mid-May 2025, reflecting holdings as of March 31st.
Okay, so who are the major holders listed in those filings? Any big names?
The sources list firms like Magnetar Financial, FMR, that's Fidelity Nvidia Corp, which is interesting to see on the list.
Yeah, very interesting.
Coatue Management, Jane Street Group, Investment Management Corp of Ontario, Blackstone Group, Altimeter Capital, Aliska Investment Group, and a Trades Management. It's a pretty notable list of significant players showing up early.
And you mentioned Nvidia's holding specifically. That's clearly a strategic investment, right? Not just passive holding.
Exactly. The sources highlight Nvidia's stake as, well, paramount, around 24.18 million shares as of May 21st, 2025. That represented about 7% of outstanding shares.
And that was up from the IPO.
Yes, noted as being up from 5.2% at the IPO, valued nearing $900 million at the time. This increase is interpreted by the sources as reflecting significant ongoing strategic backing.
And Coatue Management also accumulated a big position, you said.
Yes, led by Philippe Lafont. One source specifically noted Coatue purchased 5 million shares in Q1 2025. That likely contributed to the stock's rise. The sources also remind us of earlier institutional involvement even before the IPO, like Cisco and Pure Storage participating in a $650 million secondary sale back in November 2024.
Right.
That was at a $23 billion valuation then, showing interest pre-public market. And shares trading at a premium in secondary markets recently also suggest strong institutional demand continues.
Now, what about the insiders, the people actually running the company? What does their trading activity look like since the IPO, based on these sources?
The sources covering insider activity up to mid-May 2025 reported 18 open market trades.
Okay.
And the breakdown was just 1 purchase and 17 sales.
17 sales versus 1 purchase. That's a pretty significant tilt towards selling. Who were the major sellers, according to the sources?
Yeah, the significant sales noted include co-founder and chief strategy officer Brian M. Venturo selling around $75 million worth, director Jack D. Kojan selling about $62.7 million, and co-founder and CEO Michael N. Intrater selling around $50 million.
Wow.
The general counsel, Kristen McVitie, also had multiple sales, including some right at the IPO price, and the CFO, Nitin Agarwal, also sold at the IPO price.
Okay. And the 1 purchase, who was that?
That was by a director, Karen Boone, noted as buying around $500,000 worth.
Okay. So how do the sources interpret this heavy selling by insiders?
Well, generally, the interpretation offered is that it's pretty standard post-IPO liquidity and diversification for founders and early stakeholders, especially given they still hold very large stakes.
Right, they're cashing out some, but not all.
Exactly, but the sheer volume is noted as something that warrants ongoing monitoring. They also mention large private secondary sales by founders happening even before the IPO, around $488 million worth. So there's a history of founders taking some money off the table as the valuation grew.
Got it. Okay, switching gears again. What are the professional analysts saying about CoreWeave? What's the consensus rating? What are their price targets looking like?
Analyst coverage initiated pretty rapidly after the IPO quiet period ended. The sources report a mixed consensus, generally leaning towards hold or maybe a cautious buy.
Okay.
Some aggregations show a moderate buy rating based on, I think, 18 analysts covering it. Early in May, some sources noted a lack of any sell or strong sell ratings, though D.A. Davidson did initiate coverage with an underperform rating later.
Okay, so mostly holds or buys, 1 underperform. What about the average price target? Where does that stand relative to the, $111 stock price we just discussed from late May?
This is where the sources highlight a really significant disconnect. The average analyst price target reported is around $69.97. Let's call it $70.
$70, when the stock was trading around $111.
Exactly, with a range noted from a low of $36 up to maybe $100 or slightly higher on the high end from individual analysts. But crucially, yes, that average target is significantly below the stock's market price in late May.
So the analysts, on average at least, seem to think the market price has run far ahead of its current fundamental value.
That's precisely the interpretation offered by the sources. They suggest this disconnect implies potential near-term downside, according to the analyst models. And the wide range in individual targets from that $36 low up to, some bullish scenarios potentially reaching $120, $180 were discussed by some that clearly shows analysts have very different views on valuation right now. There's considerable disagreement.
Were there any recent analyst actions in May highlighted? Upgrades, downgrades?
Yeah, sources mentioned price target increases from firms like Citigroup. They went to $94, JP Morgan to $66, Goldman Sachs to $67, Barclays to $100, Needham to $75.
Okay, so targets moving up, but maybe not fast enough to catch the stock price.
Right. But there were also notable downgrades. D.A. Davidson initiated with that underperform rating and a $36 target. And Barclays actually downgraded their rating from overweight to equal weight, basically hold, even though they simultaneously raised their price target to $100.
Wait, so Barclays raised their price target substantially to $100, but still downgraded the stock to hold?
Exactly, which really underscores the point. The sources indicate the primary rationale for these cautious ratings or downgrades is centered squarely on valuation concerns.
Just too expensive, too fast.
That seems to be the main message. Even while acknowledging the strong long-term potential, they see the current price as having gotten ahead of itself after that incredibly rapid rally.
And what specific valuation metrics do the sources highlight as being stretched or looking high?
They point to high multiples like price to sales or PS citing ranges like 14.4 times up to maybe 25.7 times sales compared to an industry median around 9x.
Okay, that's high.
And also a EBITDA enterprise value to earnings before interest, taxes, depreciation, and amortization. That was cited around 82.5 times, again, compared much lower for peers or even Nvidia. These high multiples, according to sources, imply that significant future growth is already baked into the stock price. Beyond just valuation, the sources also note some analysts expressing concerns about potential long-term pressure on profit margins.
From where?
Due to customer bargaining power, big customers negotiating hard, plus the massive CapEx spend needed, the high debt levels we discussed, and just the general execution risks involved in scaling up this fast.
Right. But despite all that near-term caution on valuation, the overall long-term sentiment from analysts, according to the sources, still seems generally bullish. Is that fair?
Yes, that's the kind of duality presented in the material. The long-term outlook is often framed as bullish, fueled by CoreWeave's positioning in this explosive AI market, those key partnerships, Nvidia, OpenAI, and that undeniable impressive pace of revenue growth. That 420% year over year in Q1 really stands out.
Okay. What about management's perspective on all this? What are they communicating, according to these sources?
The sources summarize management's messaging as consistently emphasizing incredibly strong customer demand. They've described it using terms like robust and accelerating.
Okay.
And currently outstripping their ability to supply it, which of course necessitates the rapid scaling and those huge buildouts we talked about.
How does the CEO, Michael Intrater, frame the situation, particularly that massive CapEx plan?
The sources note Intrater defends the significant CapEx, that $20 to $23 billion plan for 2025. He calls it success-based.
Success-based.
Meaning it's tied to multi-year contracts they've already signed, essentially saying we're building because the demand is locked in.
Okay.
He's also quoted expressing a belief that Wall Street might not yet fully grasp CoreWeave's sort of novel business model and its long-term potential, feeling maybe public investors might be missing the thematic power of more compute sooner.
Interesting perspective.
And he highlighted Q1 2025 as an outstanding start for them as a public company.
So they're really leaning into the narrative that they are meeting an unprecedented demand cycle, and the spending reflects that opportunity.
Right. The sources also mentioned management acknowledged on the Q1 earnings call that earnings would likely be lumpy.
Lumpy?
Yeah, due to the CapEx ramp, which seems like managing expectations, suggesting profitability might not be a smooth, straight line upwards in the near term. Their communications seem very focused on highlighting the huge AI opportunity and the strategic wins. Some sources label it a story stock right now.
Okay. Was there any brief note on governance from the sources?
Yeah, just briefly. They mention a formal governance framework is established, experienced board members, including some individuals noted with AWS experience.
Okay.
However, they do note that founders retain significant voting power pre-IPO, and the combined CEO and chairman roles held by Michael Intrater are factors that analysts tend to monitor.
All right, standard checks. Okay, finally, let's look at the future, according to the sources you provided. What are the potential paths forward, the bullish versus the bearish scenarios, the key risks and catalysts?
The sources frame this section as really outlining the factors that could drive the stock and the company's trajectory from here. On the bullish side, the absolute key catalyst is just the continuation of this massive AI infrastructure demand.
The tide lifting their boat.
Exactly. The material describes the AI supercycle as potentially a true supercycle, suggesting this isn't just a fleeting trend, and CoreWeave is ideally positioned to capture a big chunk of it.
And converting that massive backlog we keep mentioning must be central to the bullish case.
Absolutely critical. Successful conversion of that, let's call it roughly $30 billion revenue backlog into actual recognized revenue over the next 4 to 5 years is paramount.
Okay.
Further support and maybe expanded deals with key partners like Nvidia, OpenAI, maybe Microsoft, Meta, those would also be significant validations and catalysts.
And successfully executing that huge build-out seems critical, too, just operationally, given the scale.
It's a major bullish driver if they can pull it off, yes. Rapidly and successfully building out those new data centers, deploying the latest GPUs like Nvidia's Blackwell chips efficiently, and just meeting that surging demand without major hiccups or delays. And then progress towards actual GAAP net profitability and consistent positive free cash flow as they scale. That's also a key catalyst needed. Some projections mentioned in the sources see their EBITDA margin potentially normalizing around 30–32% by FY 2026 if things go well.
And things like new customer wins, launching innovative high-margin services could also propel the bullish scenario.
Yes, particularly leveraging that Weights and Biases acquisition to offer more value-add services. And the sources do note that some bullish projections based on future potential revenue and EBITDA could justify significantly higher valuations down the road. Potential price targets reaching $120 up to maybe $180 were mentioned in some optimistic scenarios.
Okay. But there's clearly a flip side, the bearish scenario, and some significant risks mentioned throughout. What are the main concerns highlighted in the sources?
Well, the number one most cited risk, as we touched on earlier with the analyst views, is high valuation.
Right.
The sources repeatedly emphasize that the stock's rapid rise has pushed it far above traditional metrics and many analyst targets. Those high PS and EV/EBITDA multiples suggest enormous future growth is already priced in.
So vulnerable to disappointment.
Very vulnerable. It could lead to a sharp correction if market sentiment shifts, or if actual growth falls short of these very high expectations.
And executing that massive expansion, that seems like a huge challenge in itself, right? A major risk area.
Execution risk is definitely a major concern highlighted. Managing a colossal build-out, that $23 billion planned for 2025 is just fraught with potential issues.
Like what?
Delays, cost overruns, problems getting the data centers online and operational, securing reliable power sources, which is a huge issue globally, acquiring enough GPUs in a tight market, and simply successfully implementing these complex strategic plans across multiple geographies simultaneously. Management acknowledging lumpy earnings kind of signals this complexity.
The financial structure itself also seems to pose risks based on the sources.
Yes. The high debt load and significant capital requirements are flagged as a major risk factor. The sources note substantial and growing debt cited around $11.9 billion to maybe $12.9 billion issued. That leads to a very high debt-to-equity ratio mentioned, and those high interest expenses pressure cash flow and profitability. CoreWeave's reliance on continuous access to capital markets debt or equity to fund this capex is a key vulnerability.
What if that access tightens?
Well, if access tightens or the terms worsen significantly, it could force them into diluting shareholders through equity raises or lead to less favorable, more expensive financing, further impacting profitability.
Relying on just a few really big customers seems risky too, doesn't it?
Customer concentration is another risk highlighted, yes. Heavy reliance on a small number of very large clients, notably Microsoft cited as 62% of 2024 revenue in one source, and OpenAI. That creates risk.
Oh, so?
What happens if these key clients decide to build more of their own infrastructure in-house, which they are also doing? Or if their own demand profile changes significantly, it leaves CoreWeave exposed.
And they aren't the only ones trying to capture this AI infrastructure market, surely.
Exactly. Competition is intense, not just from the major hyperscalers, AWS, Azure, GCP, who are all aggressively improving their own AI offerings, but also from other specialized GPU providers cropping up. And that dependence on Nvidia is crucial for their supply, getting those latest chips, but it's also a risk. Any disruption in Nvidia's ability to supply or changes in that partnership could be detrimental. Plus, technological obsolescence is always a factor if they can't deploy the newest generations of GPUs quickly enough.
Yeah, the tech moves fast, and the stock's wild ride feels kind of tied to the broader AI narrative itself, doesn't it?
It does. The sources suggest the stock price is susceptible to market volatility and just shifts in the broader AI hype cycle. If that narrative cools off, or if some sort of AI winter scenario emerges, their valuation, which is really priced for hypergrowth, could be significantly impacted. Some analysts cited note that speculative trading dynamics might be playing a larger role in the rally than underlying fundamentals right now.
Okay. And finally, just the timeline for consistent profitability.
Right. The uncertainty in the profitability timeline is noted as a risk. Given the heavy ongoing investment, it's just not clear exactly when sustainable GAAP net profitability and consistent positive free cash flow will be achieved. Oh, and one final risk mentioned is the insider lockup expiry coming up around August 2025. That could potentially add some selling pressure to the stock as more early investors and insiders gain the ability to sell their shares on the open market.
Okay, so that really paints the picture from the sources you shared with us. A company right at the white-hot center of the AI infrastructure boom, showing truly explosive growth numbers backed strategically by key players like Nvidia.
But also navigating these immense financial challenges with high debt and unprecedented CapEx requirements. Facing significant execution hurdles and building out capacity at this incredible speed, and under intense scrutiny regarding a valuation that many analysts, according to these sources, feel has run far ahead of near-term fundamentals.